Hello and welcome to Thank God It's Friday. Well, we are excited with the weekend, yes, but we are even more excited with the fact that we have Manish Chokhani of Enam joining us. Thank you for joining us, sir.
Thanks for having me.
Of course, we will be talking about the Indian equity markets and perhaps a little bit about the investment banking scene, but there's a little bit of a surprise at the end as well, so watch out for that. But once again, I'm going to start off with the markets as usual. You know, benchmark indices is currently at 22 times. In 2007 peak, we saw benchmarks at around 23 times. 2009 sometime was 25 times. The difference, however, is that interest rates now are lower. We're looking at a little more political and economic stability.
Sure.
More legs to run. Are you skeptical or are you comfortable with the kind of levels that we look at?
Well, I'm always hopeful. When you're in equities, you always have to be an optimist.
Right.
And like you rightly pointed out, valuations are at near historical highs. And the difference is capacity utilization is very low. We are probably around 70% as opposed to 90 back then. So we do think there is operating leverage in the system if indeed this demand does come back. And if I recall back then, our profit share to GDP was somewhere around 7%. We are currently at around 4%. So we think there is room for profit to come back as capacity utilization goes up. And like you rightly point out, money is far cheaper, and it's been far cheaper for longer than I've ever known. And even Mr. Buffett then basically said that if interest rates remain so low, the reciprocal of it is really that the P multiples may remain higher than what really we are used to or what we are comfortable with. So while I don't like the valuations, it's not certainly mouth-watering or attractive entry points. It doesn't mean that it just goes away and collapses tomorrow. So it's how do I say, approach it with caution, but stay optimistic.
Okay.
All right. With no fresh capacity creation really happening, where is this earnings growth that the market is eagerly waiting for going to come from?
So Shraddha, think of the economy in three buckets. If you think of capacity creation, when we think of it, we think of large manufacturing plants and so on. But manufacturing in India is sub 15-20% thereabouts of GDP.
True.
So anyway, you're not going to see a lot of capacity going into manufacturing, and especially with the way there is surplus in the world and across the border in China. In segments where money is being made or they see the rigor of demand coming through, take auto or take cement, there is no lack of capacity coming in. Indeed, even today as we speak, Maruti will have a meeting list for their cars, for the whole Gujarat plant to come on board. The cement players are all putting capacity. The issue has been in the large lumpy investments in power or steel or maybe infrastructure related sectors. And more than the demand, it was really issues of getting the last mile closed in terms of completing the infrastructure project or getting the gas supply or the slurry supply or getting the coal for the power to start. I think as those issues are being worked through and we get this new bankruptcy code and banks are able to now harmonize and get these projects also to some semblance of viability, I would suspect that some of this would stabilize. 65% though of the economy or more is the services sector.
Which is also not having the best of time.
No, but you think of it, there is velocity of money and there is absolute volume growth. We suffered on both counts. We lost velocity of money in the last administration because of what we call as the unease of doing business in India, if I could call it that. As that is improving, I'm assuming you will get better velocity of money. When we get something like demonetization happening, it makes the economy a lot more digital, you get that much more velocity. The whole move towards GST is really about accelerating velocity in the economy and stopping all the toll nakas and creating the shift from the unorganized to the organized to get it there. Secondly, the most important thing I think which is happening now is for last 10 years, the rupee went from 40 to 68. It was a 70% loss of purchasing power. That's a loss of per capita income. So if I was someone earning, I don't know, $100,000 in 2007, it was, 40 lakh rupees was $100,000. If I'm still at that 40 lakh rupees today, I'm basically what, $65,000. I have lost purchasing power. As the rupee strengthens, I've been the long advocate of this, we must get the rupee higher because we are a net importing country. And we are paying more and more for dumb things like oil to come into the country, and a lot of our exports mythically are not real exports, because while we give a figure of 15% of GDP as exports, The reality, like I said, is we don't really export anything in agriculture, which is 10-15% of GDP.
Right.
If manufacturing is another 15, there is no way on earth we are exporting more than 3% of that.
Right.
So our net export number is surely under 5% of GDP. And to keep those guys happy or so-called competitive, we make the remaining 95% of India poorer, which depresses demand, which then depresses your efficiency and your competitiveness in any case, because then you start importing inflation from outside.
Right.
So if you put all these things together, that the purchasing power per capita income rises, interest rates go down, makes me feel really wealthier than I was, and you now start getting all these efficiency gains in the system, you put that two together and you start getting this volume and efficiency velocity moving all over again. And I think events are now converging towards that. So I'm hopeful.
Okay.
Right. You know, the equity markets have given the government rave reviews.
Sure.
We've seen equities buy in, especially after the outcome of the UP elections. What are the challenges and what are the opportunities that this government has currently, given the mandate that it has? And you know, I know that you have spoken to a certain extent about the government should be recycling their assets. In
Absolutely. Yeah. So you're right. Look, honestly, if oil was not $40, $50, we could have won UP, we could have won 500 seats out of 542, and people would still be criticizing if oil was 70.
Right.
The windfall we've got because of oil being down, inflation being down is
Yes.
unprecedented. The windfall we're getting by money being cheap in the world is unprecedented. We haven't grasped the opportunity well enough.
Right.
So while the government's done a number of fantastic things, like we spoke about making ease of doing business, getting the whole infrastructure cycle kick-started, solving the power, trying to solve the NPMS and all that. So they're all great things.
Right.
But to change the orbit, you do need to, like I said, kickstart the velocity in the economy, and that kickstarts when you create new profit cycles. And that profit cycle, if I look back to the previous NDA regime, started with them starting to privatize, getting rid of Hindustan Zinc or Maruti or VSNL and so on.
Yes.
It went to private hands, created the animal spirits, attracted investments, and made those companies a lot more efficient. And it's nobody's argument that the government should be in any of these businesses. So what are they doing running Air India? What are they doing running hotels? What are they doing running Steel Authority of India? They have nothing to prove to the world that they can manage corporations better. Their job is to legislate, not to manage. So if indeed we can get rid of these $1 trillion of assets which the government holds, on which it produces a 2% return, give it over to private hands in an open, transparent auction process, even if we get the return ratio up to even say 12%, that's an incremental $100 billion of profit in India. Incidentally, the total profit pool of all our listed stocks in India,
Right.
when you say it's a 20 multiple on a $2 trillion market cap,
Yes.
is less than $100 billion.
Right.
So we are sitting on 50% of our profit potential lying unutilized in some sense.
Right.
And if you think of the government in that sense, guys, why are you not doing this?
Yeah.
You now have the mandate. The world is eager to give you money for assets which are built up at a low cost of capital. Sell it. So when Mr. Gadkari goes and says, I'll sell a road project, or I can sell part of my power asset. Other than that, I'm saying maybe they are takers now for your refineries, for your steel plants, for your hotels, for your airlines. Lock, stock and barrel, can we think in terms of hundreds of billions of dollars of money coming in at these low costs of capital today, at elevated multiples, which we think, just get rid of it. That gives you the money to create that extra volume growth in the economy.
Yes.
And by kickstarting this, you increase the velocity manifold. So the aspirational target of 10% of GDP in terms of growth may well be the new bottom for you in terms of rate of growth.
Yes.
But as you say, if wishes were horses.
Yeah.
So one lives in hope.
Right. So there's a lot more that this
Lot more to
government
be done.
can and should
Sure.
do. All right. So we've spoken about the domestic triggers, but do you think that the Indian markets are sort of not pricing in any risks that could emerge from global events then?
It's true across the world. The fact is there is a lot of surplus capital in the world. There is no return on fixed income pretty much anywhere in the world. There is, like you say, that whole Schumpeter cycle going through where the developed world is really ex-growth. How many more cars can you sell to someone who already has 4 cars?
Right.
How many more TV sets can you sell them? How many more Starbucks can they buy, and so on?
Right.
So, and therefore the markets, if you see even in the West, are basically pricing growth.
Yeah.
So you take the top 4 companies, you take Google and Apple and Facebook and stuff like that. They basically didn't exist in 2002. And today their market cap is greater than the whole market cap of India. The top 5 companies in the world are no longer energy or auto stocks or retail stocks. It's really tech stocks, and it's really growth which is being priced. Similarly, India falls into the growth bucket, that we are the last big economy which can have unit volume growth. And therefore, logically, when you look at our consumption stocks here, you think barely 2% or 3% of India is consuming today. There is a long road 10 years ahead for these people to consume. Therefore, even if I pay a slightly higher multiple today, it may not look like that higher multiple 3 years, 4 years out. When I juxtapose that with the cost of capital of an investor overseas, and he may be at, I don't know, 3%, 5% kind of opportunity cost. For him, the reciprocal multiple is 30 is the base case. Because I look at it as a 15-20% ratio in India, I think I want a sub 10 multiple to feel comfortable. And that's what the dichotomy is. And therefore, the risk to our markets is more global than local. That if an exogenous shock occurs like 2008 or 2001, you get a meltdown in something over there, and this money becomes expensive, then the way it has come in, easy come, it'll be easy go. And a lot of these flows are now ETF or programmatic money. And therefore, in some sense, they became price agnostic. So as they are price agnostic on the way up, they'll be price agnostic on the way out. But having said that, I don't see that on the horizon with even the fears coming out of French people exiting Europe and all kind of fading. Things seem to be sort of sweet spot for now.
Like you said, the rate of change today, especially with respect to technology, is really fast. So which do you think are going to be the emerging sectors of tomorrow then?
So I just attended a program at Singularity University in California. And the dichotomy and the dilemma in my head is really that at one level interest rates are so low that they seem to suggest PE multiples should remain high. Although I feel interest rates are manipulated, so it may not really be a sustainable multiple for long. The flip side is because there is so much innovation coming in the world and disruption in so many sectors is imminent, the terminal value that I would want to pay for a number of businesses, in my mind, is shrinking very rapidly. So while the P multiples look like they should be elevated because of cost of money, the reverse in terms of terminal value going down because of disruption coming is also occurring. And what's the fine line there? Honestly, I wish I could answer it, but that's the thing that I fear the most or obsess about the most. Like just illustratively, we know the way the cost of solar is going. So we know what's going to happen to cost of energy. So if we therefore now think that oil prices basically are headed down over a 5-year trajectory, you may have a 1 month, 2 month cycle where it goes to $60-$70, but basically it's headed for 25. If that happens, it has enormous implications for India's balance of payment and rupee strength. It has enormous implications for our whole competitiveness and power costs which come into us. It has enormous implications for what happens to refining and margins and all over there.
Absolutely.
The flip is, if it is going to have that depressing effect on large market cap companies of today, does the market go up? Does the market go down? Does that stock go up? Does that stock go down? It is a dilemma. You think of medicine and the advances being made with the gene. Effectively, the whole chemical pharma industry is obsolete in 10 years. I'm not sure biology survives because it will all be now gene splicing and CRISPR can basically go change your DNA. How do I buy a pharmaceutical stock? How do I buy a healthcare stock? I mean, in theory, I could argue you don't need the doctor or the surgeon because the robot might do it. It might reduce operating costs in the hospital. But how many people now end up in the hospital? I don't know. So all I'm saying is it's interesting questions to have in the head, but that it's certainly one of the most challenging times to be an investor. And sometimes I think just knowing this is sometimes just screwing up my brain. Sometimes ignorance is bliss. It's better you didn't know what is going on. Or you say autonomous cars are coming, electric cars are coming. The whole internal combustion engine goes. In 5 years, the P multiples decay. I have a holding in Maruti, the same as many people in the market. I don't think it comes to India in 5 years. But what will the P multiples for Maruti 5 years from now be the same? I don't think the answer will be yes. So it's a challenge.
Okay, I'm going to go back to being sector specific now. Just today in its annual report, Yes Bank reported a 7-fold difference between what the bank thinks is an NPA and what RBI thinks is an NPA. And this in all case may not just be a Yes Bank specific phenomenon. Does this raise concerns on private banks underreporting their asset quality?
So I don't know the specifics of any of the case, nor do I sit inside a bank. I would suspect the RBI knows what it's doing. I can't imagine a bank saying I have a difference with my regulator in terms of what I recognize, don't recognize. Having said all of the above, I think the way the markets are looking at this whole opportunity in the financial services space is something which balances off this current fear of NPA, because that's really past. And when you normalize and you say all these NPAs are really in some sense extraordinary hits which one is taking, and at some point it ends, maybe it's already ended, I don't know. When you normalize the earnings and look out 2 years, 3 years from now, does it look like these profits are 2x, 3x? Like if you will just take FY18 earnings for the index, I suspect a lot of the earning growth may come out of public sector banks. Right. The way they last year came out of the public sector refining companies. Which is not to say everything's over and hunky-dory, it just means the base was so low that they're rising from there. But the larger opportunity set in India on a $2 trillion economy is, let's say it's a 25-30% saving economy, there's $500 billion of saving, of which only half goes into financial savings, the other half is going to real estate and gold. So you have so many now levers in your favor that 2 trillion economy is going up, therefore the 500 billion saving number is going up, and let's say in 5 years it might be $1 trillion of saving. Then the $250 billion of financial saving doubles. Right. So you already are looking at maybe 800 billion of financial savings coming. Of that, the share of private banks are 25 versus public sector 75, and that might flip.
Right.
So now you have 75% of 800, so you have a $560 billion kind of opportunity for private banks and DFCs, as opposed to 25% of 500 billion today, which is, so 125 goes to 560 is a 5x expansion for your addressable market.
Right.
And there are basically going to be 4-5 players which take that opportunity.
Right.
So when I'm taken with that size of opportunity, it's very hard to worry about what's this quarter, what's next quarter, what are the last NPA cycle. If I look out 3 years, you'll repent not looking at them at the current prices.
Absolutely.
And that's really what the market seems to be pricing in as well.
Right. So on a related note, you did speak about the shift towards financial savings. That's inevitable.
Sure.
In the stock market, if you leave the private sector out, or private banking sector out, what are the other ways by which?
So there are lots, no? You take the whole cut. So there are banks, there are NBFCs, there's now insurance companies, there in some sense you play the stock exchanges.
Yes.
They're all a manifestation of that. At some point you'll get a mutual fund which will get listed. Right. So there are just so many different ways you can, cut the whole space.
Okay. And once again, I want to address cryptocurrency now, because the idea of Bitcoin was that it would be a currency without any regulations.
Right.
This will come into play, in the near term. It's already in play right now, but there will be plenty more cryptocurrencies which will come into play. What does this mean for traditional financial systems?
Well, cryptocurrency is a small part of what is the larger ecosystem called the blockchain, which is really a distributed ledger.
Right.
And the distributed ledger is basically, I like to describe it as, you used to have a mainframe computer.
Yes.
Then you went to client server, which was the PC on your desk, and then you went to cloud.
Right.
And if you think of the banks today being the distributed architecture of the client server architecture, having bank branches and so on, when you swipe your credit card today, it basically goes to the bank for verification and then comes back. The bank is really the medium of trust.
Yes.
And the central mainframe controlling all these PCs is the central bank. What the blockchain is really a distributed ledger, which is in a way the cloud.
Right.
Because it's a distributed ledger and nobody can now hack each other's computer because you need all of them to be working together.
Yes.
It takes the element of trust from one central repository to a distributed architecture.
Right.
So the architecture of banking, the way we know, will change. The Bitcoin is just one tiny aspect of it, because that's more a question of regulation and how we want currencies take the power away from the central banks.
Right.
And Bitcoin, by the way, is probably 90% traded in China. There are already 90 other cryptocurrencies. Some countries will at some point make these cryptocurrencies legal, but it's a battle between technology and regulation. So which central bank or which government is readily going to give away the power to print currency? So we'll see how that plays out. So it's really still an underground market for smuggled goods or informal markets or drugs and stuff like that.
Yes.
It will get mainstream by and by, because every fashion will at some point get mainstream. But the larger, it's a challenge as well as an opportunity for banks. Because now if I can harness blockchain to, for example, take this whole business to SME, and the whole element in SME was trust and verification. So unlike a large corporate where I can get a AAA rating, or in a retail lending I can go to CIBIL and get a credit score, how do I do that for an SME? And a lot of them, remember, wholesalers trade in cash in India. How do I get the digital imprint? If I start getting distributed trust verification from using blockchain technology from across the whole SME space, their vendors, as well as their customers, it might make the whole verification process easier. So it could be an expansionary possibility for banks. At the same time, you may think, I don't need the bank branch because I have a blockchain, and do away with the bank.
Absolutely. Yeah.
So it's a question of which element of trust do you want more. Like similarly, when I remember in the past when ATMs came, we thought that's the end of banks because you put an ATM and you don't need to go to the branch anymore. And the reverse occurred, because wherever you put an ATM, the consumer thought, hey, my cash is here, it's secure here, I can trust this bank. And actually, perversely, if you track ATM with the deposit growth of CASA in banks, it actually correlates perfectly.
Right.
So wherever you have a ATM, CASA growth is high over there. So I think this is fun, evolving, and I think India is ahead of the game, because you take all our leading private banks, whether it's Kotak or Axis or HDFC or ICICI, they all are playing the tech game much better than what I see even in the West. Because they are sitting on legacy systems there, and we guys don't really have so much of legacy to deal with. So I see this as an opportunity for ourselves.
Okay, I'm going to shift focus to real estate. The NSE Realty Index is up 35% since November 8th. Against Nifty's run off about 10%. Now, demonetization wasn't a dampener, neither has been RERA, the Real Estate Regulation Act. You've been tracking the sector closely. Your thoughts on it?
It's a positive. I mean, honestly, real estate was the most unorganized and deceptive sector. The maximum amount of consumer money went into it, and the maximum badmashi, if I may use the term, happened over there.
Yeah.
What you're buying, you don't know. Till the day you get possession, you don't know. Whether you'll get possession, you don't know.
Absolutely.
The coming of the Real Estate Regulation Act is a bit like the change when in the old days of BSE, we had the Vyaj Badla system and open outcry, settlements would shift at will, duplicate share certificates would come. And you made the system transparent with timestamp and dematerialization and so on, and you attracted investors into the market. In some sense, I'm hopeful that RERA does that. That the organized players, whether it's a Godrej or a Oberoi or a Hage or whoever, they start gaining more traction because they can put up the information. Like I saw the first day was Naman Builders who put all the information up about RERA on the net. It would be natural that the more transparent and organized players gain in this. You may start getting a lot more joint developments, and as a buyer I now feel a lot more confident, because like I see my company's results every quarter with the balance sheet and all the disclosures, I now can see the whole project online as well, what I'm getting, when I'm getting, what is going up and so on. I suspect a lot of money will now come both for actual users as well as for investors in this space as well. Like you saw these investment trusts coming for utility assets, I won't be surprised if you'll see real estate trusts coming as well. It is a large source of fixed income for people all over the world. We've lacked access to it, and like we get a share of a business by buying one stock, can I hedge myself in real estate if I want to buy a larger house by keeping on buying units of houses of reputed developers? I think this business will evolve, and like I said, even today we probably do more than $200-250 billion of real estate in India every year, and people still love to own that physical real estate. It was seen as a store of value because the rupee kept depreciating and inflation eroded, and at least real estate held its value. If I get a chance to do that directly with a reputed person in a corporate governance framework, in a regulated framework, there are good times ahead for the good players. So there will be in this big winners, big losers. And I think markets rewarding that. You saw, for example, the way you said real estate index, but it's really like when you say a sector booms, the best and the worst both move.
True.
So you'll see a Godrej Properties moving on a result spectacularly, but you'll also see the worst stock, because it would have probably been an 8 rupee stock and it goes to 15 and it looks like it's doubled. But that's how it is.
All right, just the last question from my end. Warren Buffett, of course, has famously said that his holding period, favorite holding period is forever. But then business models, managements and regulatory environments do change, unfortunately. Is there an idle holding investment period for you, and when do you decide if it's the right time to make an exit?
So I agree, the ideal investment period is you find a great business which can keep earning incremental return on capital at a high rate, and therefore I never have to sell it, because what I've invested in I know a lot more than what I have not invested in. So when you sell something, it's very painful because you have to go and get familiar with something which you're less familiar with. Having said that, the rate of change is so fast in this VUCA world that you have no choice. I do not think the buy and hold 10-year, 20-year vision holds anymore. Even if I look at Mr. Buffett's portfolio, he used to own Coke, he used to own Wall Street Journal, World Book. A lot of those businesses are not as relevant anymore. And he's making changes to his investment style as well, and we are just students of the master. And if the master is changing, the student must change as well.
Absolutely.
And it is the reality. Like I said before, disruptions coming at such a rapid pace.
True.
I cannot say, 10 years from now, the stock I'm holding today will still be in my portfolio. I'd be foolish to not always be paranoid about what I'm holding. I hate selling things because I buy very few stocks. I typically don't have more than 20 holdings in my portfolio. But as I become more and more nervous about the impact of technology, the solution for the ignorant is to diversify, but it doesn't solve the problem. So it just means I have to go and learn and investigate harder. That's the best I can offer at this point.
All right.
I don't know if that answers your question.
It does.
Well, okay, so now I'm going to come to the question that I have been waiting to ask you about this course that you did in California. Can you tell us a little more about the takeaways from this course, what this course was all about?
Okay, so it's a free plug for the university, I guess. So Singularity University is a campus in the NASA Ames Center.
Right.
This is basically a Google campus in Mountain View. And their tagline basically saying most places you go to study teach you about the past. We like to teach you about the future. And so they basically run executive programs or sector specific programs across different facets of technology. So I attended a program where I learned about the future of energy, the future of medicine, bioengineering, biotechnology, artificial intelligence, robotics, Internet of Things, the whole gamut of things. And it literally rewires your brain. Because while you read about a lot of things, or you can follow a lot of it on YouTube, Google, learn a lot of things. And my nature has, if you followed me, I read history, I read psychology, I read investing books, because investing is really a confluence of everything. But the rate of change in technology, I think, is unprecedented. And because the world has become X-growth, the need for innovating is higher than it's ever been before. So when you put that together with the fact that capital is cheap, computing power, energy power, cost, the genome costs are dropping dramatically. There is big change coming in the next 5 years. In the stock market, we discount things much ahead of time. So what will change in 2025 may be discounted in 2020. Like you're seeing already, say our tech companies here are still making $2, $3, $4 billion of profit, but the P multiples have decayed. Or the pharmaceutical companies are still making great ROEs, but the P multiples have decayed because, like I said earlier, chemistry is dead. In some sense, biology is dead. It may be all about genetics. That changes everything. If the autonomous car comes, solar power comes, medicine changes, technology changes, how do you value these businesses? So it's if you owe it to yourself to keep abreast of what's happening in technology.
Okay, so to a certain extent, I understand you're suggesting that we're never going to be fully in control of our future.
We never
but
were.
Now it's going to be even less.
We never were. You can just keep educating yourself, invest in yourself. That's the best investment. And stay ahead of the game. If you think of our top 20 companies in 1990 when I started in the markets, they don't exist. At least they're not relevant from a stock market perspective. I suspect a lot of the companies we are listing in the top 10 today may be irrelevant in the next 10 or 15 years. It's just that 10 or 15 years is coming faster than I thought. So that's all I can offer you at this point.
There you go.
So the future is you guys. All the youngsters know more about investing than all the old fogies now.
I hope so.
So do I. Well, Manish Chokhani, it was a pleasure speaking with you.
Likewise.
Thank you very much for your time.
Thanks.
And as for you guys, we will see you next week once again on another edition of Thank God It's Friday. Till then, it's goodbye.